A friend of mine who is an expert in stock trading achieved a remarkable feat of doubling his capital in 6 months using only the MACD indicator. However, it's worth noting that despite its apparent simplicity, 90% of retail investors fail to use it correctly, which could lead to unnecessary losses and risks. Therefore, it is crucial to learn and master the MACD indicator to avoid such situations and attain better returns. Hello and welcome to Trading with TA. Today, we will be discussing the highly effective MACD indicator and how it can help you achieve higher returns and better risk management in the stock market. If you are new to this channel, be sure to like and subscribe for more practical tips and insights on stock trading. Our video has 2 parts. Firstly, we will explain the buying and selling rules of the MACD indicator in practical trading to help you master its usage techniques. Secondly, we will share how to improve the success rate of buying and selling points in practical trading by changing the indicator's parameters. These techniques and experiences are practical and will help you achieve better returns and risk control in the stock market. To understand the first tip, let's start with the 3 components of the MACD indicator. It consists of a middle zero line and 2 lines, the fast line and the slow line. When both lines are above the zero line, it's a relatively safe bullish area. Conversely, when both lines are below the zero line, it's a relatively bearish area. In this situation, buying can result in losing money. Therefore, keeping this tip in mind helps to better understand stock market trends, manage risk, and gain profits. Looking at Tesla's daily chart, it's evident that the stock has been in a continuous downtrend, hitting new lows for an extended period. The yellow line on the chart marks a crucial dividend point. From this day onwards, both the white fast line and the yellow slow line have remained below the zero axis. Hence, any attempt at taking long position in the coming months may result in significant losses since the stock is weak below the zero axis. It's advisable to avoid trading if possible. Even if you come across some golden cross buy points, exercise caution as the stock is in a weak position below the zero axis. Now let's examine another chart. Prior to the yellow arrow on this chart, both the white and yellow lines were below the zero axis for an extended period, making it difficult to find trading opportunities. However, since both lines cross above the zero axis at this point, it's now relatively safe to trade and make profits. Even if there is a pullback, it's still possible to continue making new highs. Safety should always be the top priority. Strategy 2, the golden cross above the zero line is generally a buying point, which refers to the fast line crossing above the slow line. On the chart, there are 4 instances where the fast line crosses the slow line above the zero axis, which are all safe buying points. The golden cross closer to the zero axis is better because it indicates a deep enough previous correction. The first point in the chart is a biased buying point, as it is a starting point for a large wave. Moving on to the third strategy, the golden cross below the zero line can indicate a signal for rebounding, but it's important to note that this doesn't guarantee a strong rebound. The 6 instances of golden cross below the zero line in the chart may give the impression of a good buying opportunity, but it's important to remember that investing in stocks is not about gambling. As seen in the chart of Tesla, investors who follow this rule and bought at the golden cross below the zero line lost heavily because the rebound was weak. So the fourth strategy is bottom fishing with bottom divergence. When stock prices hit new lows, but the MACD does not follow, it forms a bottom divergence. This often occurs at the end of a downtrend, and on the surface, the stock price may still create new lows, but in reality, the selling pressure has already weakened. This can be a good opportunity for aggressive investors to enter a small position, but it's important to manage risk as bottom fishing itself carries significant risks. Strategy 5 suggests using top divergence as a signal to sell when the stock price reaches a new high, but the MACD does not reach a new high. This is a sign of a potential trend reversal in the later stages of an uptrend, and investors can consider reducing their positions. The sixth strategy suggests selling when there is a dead cross below the zero axis, indicating the end of the rebound and the beginning of a sharp decline. This is an excellent short selling position in a weak market. While these 6 strategies can be helpful in trading, there are other parameters that institutional investors often use to make their MACD analysis more efficient. By changing the default settings from 9, 12, and 26 to 5, 34, and 5, investors may be able to find better buy and sell points in the market. For example, the daily chart of TSLQ can be used to demonstrate the effectiveness of using institutional parameters. When using the default parameters, the buy point may be relatively high, but with the institutional parameters, investors may find better buy points for the stock. Overall, these strategies and parameters can be useful tools for investors looking to make more informed decisions in the stock market. However, it's important to remember that no strategy is foolproof, and risk management is always key in any investment decision. Thank you for watching this video. I hope you have learned some valuable knowledge and can benefit from it in your actual trading. If you enjoyed this video, please subscribe to my channel and share it with your friends. If you have any questions or suggestions, please leave a message in the comment section and I will do my best to answer. Thank you for watching.